there is no better place to get answers about inflation, the economy, and your money than right here at Milken. I can't think of two better guests to kick off this big hour with on a Monday. Joining us, California State Teachers Retirement System CIO Chris Ailman and Tikehau Capital founder and CEO Mathieu Chabran. In total, their firms manage more than $380 billion in assets. Chris, Mathieu, thanks for joining us. I know it's kind of hard to hear, there's a lot going on, but I love that energy. Chris, we're going to start with you. You're going to retire in June.
Yeah.
By the way, don't go. But we appreciate all that you've been with CNBC over the last number of years. We appreciate you. All right, so you're running this gigantic pool of assets. Your job is not to screw it up, right? Make sure the money is there for all the teachers that rely on you in the pension system. What's your take on rates, inflation in the market right now?
You know, Brian, I got to make 7% a year. Every year that I come here and I talk to you, I think back, what is this next year going to be like? Last year, rates were rising. I thought it would be a tough year. Look at the rate of return in equities. Private equity, real estate flat, fixed income's coming back. I think that basically inflation's going to be sticky. Betting on the Fed is going to be hard, but look where the market was. We were expecting 6 cuts just 4 months ago. Now we're at none, maybe 1, and the market's doing okay. So the amount of innovation I'm hearing here is really amazing, and I think we're going to be okay.
You were one of our guests last year, so I can't insult everyone. I was going to insult Mathieu, every guest at our conference last year, but since you were one of them, I will not do that. But every other guest, Mathieu, and these are some of the smartest people in the world, were basically like, oh, when the recession hits, when the hard landing hits, when the Fed cuts 6 times. And with all due respect to all these really bright people around us, they got it wrong. What happened?
Well, I think, there was a lot of wishful thinking because, when you get something for free, you come back and people got used to free money. I think that people, got used to these 10 years where they forgot that money had some value and liquidity had a cost. I remember not last year, but 2 years ago, here at the conference, when interest rates, started rising, all of a sudden people started panicking, high risky assets, venture, cryptos, you name it. All of a sudden they were trying to reprice, but it's back to corporate finance 1.0, right? If the price of an asset is the future cash flow discounted at a risk-free rate plus a risk premium, obviously, there is a repricing of these assets. And right now, there is a lot of wishful thinking in my view. The long-term interest rate might be actually lower relative to the short-term because I agree with Chris, the sticky structural inflation on the short end of the curve is here to stay.
So Chris, how do you change your investment thesis in a higher or stickier for longer scenario?
You buy fixed income, you go variable rate with
just
private
government
credit.
Debt, let it ride?
No, you got to buy up and down the curve, and you got to buy private credit because then you get a spread. But you also diversify your assets. You want physical assets that does the best in inflation. Inflation is going to be popping up in very different ways, so you can't just buy commodities, you can't just buy tips. You've got to buy different baskets of goods and spread the assets. People in IRAs and 401ks have got to pull out that statement and rebalance their portfolio. Everybody has way too long equities and the Magnificent Seven, and I think they need to rebalance. Mid-caps are a decent place to be. Small caps eventually will come back, but you're
eventually,
right.
Okay, so it's important what you're saying. All the people out there listening, well, Chris just said, basically, if you're just Mag 7 or big cap stocks, you might want to think about pulling back on some of those. Go more mid, go more small. But I thought small and mids were super subjected to the vagaries of the interest rate market. And if rates don't go down, how can they do well?
They are because of the financial side of small cap, Brian. But I really think you're going to see some amazing innovation. You're going to have the Magnificent Seven, the AI stocks do well, but you're going to see other names do well. The whole key is you got to put more than one egg in one basket and spread it out because we may have a downside. We do have 2 big wars going. We've got risk all over the place, but we have a quiet Fed who's pausing, maybe cutting. That's a good time to be invested.
I mean, the point that Chris, just made about this large cap, I can't agree more because they've been, it's a magnet to the liquidity. And, liquidity is everywhere, but remember that the central bank, the Fed, the ECB, they're slowly drying that up, and you've got the remaining, the marginal liquidity chasing the same assets. and effectively leaving some part of the market. Chris mentioned private credit. I can't agree more. Compounding basket of credit, floating rate, you will beat the inflation and create some real returns. Mid-market, small cap. I'm a publicly traded company. I'm a 4 billion market cap company. Who is interested in a 4 billion market cap today? Very limited, because they're all gating into the same stock. And I agree that when and if we need to remove this liquidity, that might bite hard.
Well, the Fed is changing. They're not changing rates, but they're changing their quantitative tightening program. And we just bring that chart back up, guys, that we're 1% away off our highs from the S&P, or 1.1% away from our all-time highs of the NASDAQ. Chris is talking about two wars. We're going to talk to Bill Browder in a few minutes about Russia doing nuclear drills. And here we have a stock market that's 1% from its record high, Matthew. I'm not trying to be a fearmonger, but make that make sense. The market's not pricing in any risk.
I think, confidence is about stability. Is there stability in the world? I don't think so. It's about, do you know how much it's costing you? You don't think so because of the rates. Is there effectively the growth? I'm questioning that, The market might be right, right now. I strongly disagree, because as a long-term asset allocator, and I'm sure that Chris as a long-term asset owner, we cannot just time the market. We're here to deliver this 7% on our side, a premium to that over the long term. And this allocation has to be built around compounding assets.
Hey, Brian, you can bust me. I was one of those guests last year that was saying the recession will come. So I'll go out on a record with that.
I was trying to let you off the hook. I was trying to let you off the hook.
That's all right. No, I'll go on. I said what I've said. Right now, I would expect this market to be very choppy the rest of this year and into the election. And I would be worried about a recession at the beginning of 25. The debt is going to be huge. So we'll see. I'll come back a year from now. We can see if I'm right, or again, if I'm wrong.
If you come back, you'll be a guest, because you'll be retired, Chris Ailments. You just come back and say you'll be in a t-shirt. It's going to be great. Matthew, really appreciate it. Chris, both of you guys, thanks for kicking it off.